up, guys, and welcome to another edition of Market Marauders, beating the market one trade at a time. First things first, smash that subscribe button down below, like, comment, share. So let's dive into it. So today, I've been going over my top 3 option picks for the week. Um, so let's dive into it. The first one's going to be ticker sign triple BY, which is going to be Bed Bath and Beyond. Their moving average 50 is 1554, and their moving average 200 is 1247. And they closed the market on Friday the 14th at 1118. So they're well below their moving average 50 and their moving average 200. Um, let's look at another chart and see what's going on where they dropped off at. So if we see this chart right here, uh, they were up pretty much during January. They were up about 16, 15. They dropped off towards the end of January to about 14, 17. They went back up, rallied back up to about 1582. This is towards the beginning of February. But then on the 11th of February, it dropped off significantly, and it went all the way down to about 1104, 1097, 1104. And then it rallied up just a little bit, and it went back down to 1118. So uh, let's go into their company press release and see what happened on the 11th that caused this drastic drop. So if we go to one of the press releases, this is from February 11th. This is the day that that drop happened. It says Bed Bath & Beyond Incorporated provided an update on fourth quarter financial performance, and it was not good. So if we go to read the statement right here, fiscal December 2019, January 2020 comparable sales, says for the first 2 months of the fiscal 2019 quarter, December 2019 and January 2020, the company's comparable sales declined 5.4%, reflecting a low double-digit percentage decrease in transactions in stores, partially offset by a mid-single-digit percentage increase in the average transaction amount. On a directional basis, comparable sales from stores declined nearly 11%, while comparable sales from digital channels grew approximately 20%. So basically, it just means that, the company is making more money online digitally through their online store than they are through physical stores. But it says comparable sales declined 5.4%. So it looks to be as though they're losing money when it comes to sales. They're missing their targets. So this is not good when it comes to a company. Um, you know, Basically any company that's focused on the sales industry wants to make money. You want to see those numbers grow and grow at large percentages or any percentage really. But when a company shows you that they're losing money and that they can't, make sales, it throws red flags to investors, and it's hard for people to invest in the company, and a lot of people end up selling off large portions of the shares. So since this is the case, I believe a lot of people are going to continue selling off the shares, and they can go even lower. When something like this happens with a company, it usually takes like a large effort company wide in order for it to fix it. So usually it's like new CEOs or new management people, new business strategies, a lot of upper level management people being moved around, a lot of different sale initiatives, different marketing strategies, but all those take different people. And so, combined with all those things together, for a company to do that, it's going to take quite a bit of time for them to restructure that so that they can start making money again. So I think until that happens, which is a gradual process, I think it's going to continue to fall, and I think it's going to continue to go down. So I would say, for me, this is why I chose it for one of my options for the week. And I would say, on a put. So this is the Robinhood app. Uh, this is the online version of the Robinhood app. Uh, this is where I trade all my options. There's a link down below in the description where you can sign up. If you sign up, I'll get a free share. You'll get a free share. So just an incentive to sign up through that. Um, but this is how I do all my options trading. And this is just to shed light on, how to begin options trading and show you some relative prices that are out there for options trading. So if you guys are new to options, uh, this is basically the options portal. There are other options, I guess, trade sites out there. There's Tastyworks and Webull, but I don't use those, so I can't really speak on those. But I can explain the process on Robinhood. So for those who are new to options, uh, I only buy options. I don't sell options. So this video is just going to be going over the buy side of options. So you have a call and you have a put. A put basically means that you expect the price to go down to a certain value and keep going past that certain value. Buying a call is you expect the price to go up above a certain value and to keep going up. So basically, a call is going to be for a bullish market, and a put is going to be for a bearish play in the market, in simpler terms. So if you go to take for example, we're on puts, so this is what I would do for this stock because I believe it's going to continue to fall. If we look at puts, this is an $11 put, so this, I mean, it's an $11 strike price, which means that you believe that the stock is going to go down uh, to below $11 in a month, a little under a month, really. So you have $11 is the strike price, and the share price is currently 11.18. So you believe it's going to go down below $11 in the time span of less than a month. Um, Now, for all options, they're contracts. So when you buy this, you're essentially buying a contract, and that's just a contract to buy 100 shares at this certain price. So 11 $11 strike price, and you're agreeing to buy a contract which is equivalent to 100 shares at 72 cents a share. So the price that you pay as the investor would be $72. So when you pay $72, you're agreeing that the stock's going to go down below $11 and you're going to sell this contract for 72 cents a share. Now, once you buy it, if it gets past this, if it goes below this $11, then your uh, price is more valuable. You make more money. So if we go above here, uh, so if we look down here below, these are all out of the money options, which means that they have not gotten to this price yet, and that's why they're a lot cheaper than these in the money options. These in the money options basically are options that someone said, okay, I believe the price is going to go below $12.50, and it has. It's at 11.18, so this is the value of theirs. So this would be equivalent to $174 per contract. So if you have multiple contracts, just multiply that times the amount of contracts that you own. But if we go back to this one, the $72 one, these prices are not stagnant. So this is just based on this current price. Now, if the market opens and it drops down to, like, let's say $10, then these two options would be considered in the money. So because it's gone down to $10, these will be in the money options. So their price will no longer be $72 and $48. Their price will go up because it is already meeting its qualification to be in the money. But if we go down here and we look, a lot of people say, oh, you need thousands of dollars to get invested into the stock market. I don't believe that's true. If we look at some of these options, they're $12, $20, $31, $48, $72. This is $7. This is $7. You know, they're not that expensive when it comes to that. And this just goes to show, $12 and $20. $20 is like the price of food these days. So, this is your average I'm going out to eat meal a day. This is what a lot of people spend a day or a meal uh, nowadays. So like, this is breakfast, lunch, and dinner for someone. Uh, and this may be breakfast, lunch, and dinner for someone, and this may be just like lunch for someone. Everyone has a different price, different budget, different price points. But I think, between $7 and $12 and $20, between these three, you know, I think someone could, come up with that amount of money to begin investing. I don't think it's, too unreasonable, especially when people tell you you need tens of thousands of dollars to begin investing. I don't believe that. But anyway, they're my first choice, and I would definitely say a put on them because based on that article, it seems like they have a lot of things going on with the company, and I think they're going to continue to struggle, and I think investors are going to continue to sell off as time goes on, which means your put will be more valuable because the stock price is going to continue to go down. So for my number two, ticker sign BYND. So this is Beyond Meat. Their moving average 50 is 95.69. Moving average 200 is 121.98, and they are currently at 116.22. So you know, I think Beyond Meat is a really good play. They've been doing a lot of things. If we go to another chart, uh, they had a lot of fluctuation um, in their chart. Let's go to the 3 month, 6 month. So yeah, on their 6 month chart, we can see that they went down a little bit and they came back up. They were up pretty high and they went down, but you know the one thing is that their earnings is coming up. So I think once their earnings come, then we'll definitely see the stock shoot back up. In my opinion, if we go to their old earnings, so their old earnings, this is the last one that was in October. It says net revenue increased 250% year over year to 92 million. Gross profit improved 32.8 million or 35.6% gross margin. Net income increased to 4.1 million or 0.06 earnings per diluted share. Company raised full year 2019 outlook. So basically, they've increased their revenue to 92 million, and this was in October. So this is before, they had all those deals that came through. Before they released the press releases about talks with McDonald's and KFC, and talks with Starbucks and talks with I think Snoop Dogg about his line. So, this definitely is going to increase, in my opinion, from then because a lot of things have happened since October um, to increase this sales number. So, I'm put them at my number two because I think once their earnings comes out, the stock's going to shoot up tremendously. And I would say for Beyond Meat, BYND, a call would probably be the best option. March 6th is a good timeline because their earnings is either next week or the week after. So it gives you a little buffer for that to change. Now these are a little bit on the higher end when it comes to purchasing options. But if we go and we look at it in a smart way, their moving average 200 is 121.98. So that's going to be the basis that I would say start at when you get to investing, and I would say just do minus $10 from that, and that will be your range. So 121 is a strike price. $763 would be that price. and then we go $10 down from that to 131, 575 would be your low end strike, your low end price. So $575 and $763, anywhere in between that range. Now, that may be a little bit on the more expensive side. You may want to go more out of the money. The cheapest one on here I'm seeing is $111 for 176, but you know it's still $111, and I think there's a lower risk with uh, having these that are closer to the moving average 200, because I think it'll get closer to the moving average 200 than it will get to anything else. Just because it's been there before, and we look at this chart, it's been well above, you know, last drop off. Can't really see it on that one, but last drop off high was 167. So you know you could probably go all the way down to 167 or 165, but you're still paying $149 for it. So you know, compared to the Bed Bath and Beyond one, this one is a little more expensive in terms of buying options, but it's doable um, considering the earnings coming up and all the things going on with the company. So for my number three, ticker sign DPZ. So this is Domino's Pizza. Their moving average 50 is 286.71. Moving average 200 is 268.16, and they're currently at 291.60. So going to another one of their charts, their earnings is actually next week, so look forward to that. It's one of the reasons why I chose them, because their earnings is next week. I think the earnings is going to be really good. We could see the stock kind of start to rally up around the 11th, and it kind of shot up. I think it's going to continue that trend moving upward, um, especially after the earnings, because this earnings will be a reflection of the earnings from holidays. But if we look on here, it was at like 297. That was like the spike. I think this 3 month spike was 297, and it's currently at 291. So it's well on its way to be back where that spike was between like 298 and 297. So going into Domino's Pizza, this is their last earnings. It says global retail sales growth of 5.8% or 7.5% excluding foreign currency impact. U.S. same-store sales growth of 2.4%. International same-store sales growth of 1.7%. Global net store growth of 214. Diluted EPS up 5.1% to 2.05. And the company announces a new 2 to 3 year outlook. So they have strategies moving forward to expand the company. Not expand the company, to business plan. Have a set in stone business plan, which is always good and helps investors, uh, you know, look forward to seeing that they have plans to move the company in terms of growth. Their global sales increased 5.8%. That just shows that they're a continuous growing business. The U.S. store sales growth 2.4%. That also shows that the company is growing on a large scale, which is always good and helps to get more revenue into the company. So for me, I would say a call would probably be the best option. Since their earnings is next week, I would say March 6th is definitely a good date for expiration date. If we look back in the history of the stock, 297, 298, almost 300 is a price that, is kind of its high, so that's where I would start looking at. So 297. If we look at 297 for March 6th, it's pretty expensive, $715 for that strike price. But, you know, this interval right here is like a little under a month away, so you got a few weeks for it to catch up. So I would say, starting at 320 going down wouldn't be too bad. So 320, you got 143. $143 and going all the way down to $715. I think that's a pretty good range when it comes to buying um, an option or a contract. So, I think Domino Pizza is going to have a good earnings. And based on when this came out October 8th. So, after October 8th, they basically have, you got most major holidays. So you have Thanksgiving, you got Christmas, you got Halloween because this was released before Halloween. So all those metrics are going to be considered when it comes to this next earnings. So those are always good things to have to show, sales increase and large numbers of sales increase because they can compare it to last year's sales of during the holidays, and it really shows you how the company is growing overall. So I think this is a pretty important earnings for the company, just because it shows more of a total growth of the company instead of just showing, there was 2.4%. You can really show how the company has shined when it comes to holiday sales. And holiday sales definitely boost revenue. So yeah, I would say between the 320 strike price and the 297 strike price, with the $143 um, contract cost to the $715 contract cost. I think anywhere in between would probably be a pretty safe bet. Um, and I mean, you may even want to go to 330. The cheapest one I see on here is this $35 one. There's a $73 one, but then again, these prices are not stagnant. So, you know, these prices will always change. But just remember these strike prices. These strike prices won't change. So, you know, 297 to 320 is a pretty good range. These prices will change, but just remember these strike prices. Anyway, drop a comment down below. Tell me what you guys are looking at. What stocks pique your interest. What options you guys are holding for next week and the weeks moving forward. Make sure you hit that subscribe button down below. Like, comment, share. And I'll see you guys next time. Peace.